Hi, my name is Tony Suick. I'm a financial advisor and I'm one of the partners here at Lifetime Retirement Partners. I'm here today to walk you through our market and economic framework. We expect this to be a monthly presentation, and the idea is to, in a window, a fairly small window, 10 to 15 minutes max, I want to walk you through where the stock market was in April, how the economy looks in our opinion, and where do we kind of think things are going. It's going to be a lot of material to really give you an understanding of those ideas. And so I'm going to start moving through things pretty quick. I will tell you first, everything you see here is available on our website. So if you go there, you can find obviously this YouTube video. You can find a text-based version of the framework, and on the website, you can find the slideshow, the slide deck we're going to go through here today. You can also sign up for a newsletter to receive this on a monthly basis. And so in the interest of time, I'm going to jump right into it and talk about what did we see in April first, and then kind of where do we think we are in the economy. April was a very interesting month, and I'll give you just a little bit of background where in January and February, we saw what's really a fairly standard sector rotation, meaning that money was moving from some sectors into other sectors, and in specific, growth was down, and money was moving out of growth stocks and into international, into small cap, into value. And that was really the tail of the start of the year. And then it totally changed once Iran, the conflict started. And instead of just growth stocks being out of fashion and being down, for that roughly 30-day window from late February to late March, everything joined in terms of being down in the market. Gold was down, bonds were down. There really wasn't a lot of places to hide for that 30-day window. I think April 2nd, I believe, was the bottom of the market. Might have been a day or two before that. And then all of a sudden we saw this dramatic rebound in April. And so when you look at some of these numbers, don't forget that's from a low starting point, meaning we were down for the year. The NASDAQ was down pretty significantly. So when you look at that and you say, well, up 18.3% in April. Well, sure, but a lot of that, not all of it, but a lot of it was recovery from what had been a decline. The S&P 500 up 12.5% in a single month. The Dow 30 up almost 9%. Russell 2000 small cap stocks up 12%. And then to me, probably the most interesting one on here is the gold. And the reason I say it's interesting is because for most of the last year plus, gold had been moving almost in tandem with stocks. So instead of working kind of counter cyclically, we had seen gold moving up along with stocks for most of the year. And then all of a sudden, gold, like I said, gold's down starting in March, but it doesn't really rejoin the party in terms of returning to growth. And so it really didn't work as a defensive asset, and now it's not working as a growth asset either so far in 2026. And then, of course, oil up pretty dramatically, down pretty dramatically, and then gradually moving up again over the course of April. At Lifetime Retirement Partners, we maintain a series of indexes, and these are designed to tell us different things in the market. The first one's the Lifetime Momentum and Volatility Index. And what that is a calculation of a couple underlying components that are meant to gauge momentum in the stock market. And the VIX, the Volatility Index, is a big component in that as well. That started and I'm just looking at the blue graph down here, that started the year positive, but swung at the end of January to negative based on AI fears and based on the Iran conflict. All of a sudden, starting there, we were kind of in no man's land already, and that turned into a negative indicator. And the way we apply that, just very shortly, is in some investment allocations, the bylaws will say this allocation can be between 90% and 100% in stocks, and this is what kind of helps us decide, okay, is it time to be a little more aggressive? Is it time to be a little more conservative? And so you would dial down risk a little bit during these negative indicators. But then you see here that big spike towards the end of the blue bars was April 3rd, where all of a sudden, over the course of a couple of weeks, we had gone from -2 to 0, which is really the buying indicator, and then all the way up to -4. And so you would be back to a full expression of risk. This indicator is currently at a +3, which indicates a risk on exposure. So any defensiveness we had built in to some portfolios had been completely reversed by the time that April 3rd kind of came around. We maintaining another indicator called the early warning system, and that's updated weekly. And it's meant to give, not to necessarily predict recessions, but it's meant to give us an understanding of how much fragility is in the stock market. And so we're looking at what would be considered early economic indicators to gauge potential pieces of risk that tend to flare up before you see a downturn. I'm not going to spend much time on it because you can see that's been fairly benign for the last 52 weeks, up a little bit going back a year around Liberation Day. But then you can see very benign readings down here, currently a score of 2.3. That's on a scale of 0 to 10. So not a lot of fragility that we're detecting in the economy right now. So in terms of the big macro picture, that's the first kind of check mark to say that things look good. Now, I'll talk about stock investment levels for a minute, and when we do that, we're usually looking at the price to earnings ratio. And so price to earnings, you take the price of a stock, you divide it by what it's earning, and the purpose is to create a comparable ratio from stock to stock to stock. And you can do that, add the stock values of all 500 S&P companies divided by the profits of all 500 S&P companies. You get the same thing for the index. And so we're usually using in these discussions the S&P 500 as a proxy. That finished the month using week-end values at 25.41 in terms of its price to earning ratios, which if you compare that to where it was a year ago is up fairly dramatically, 22.14. I will tell you it's a little bit of a misleading comparison because the stock market was still down pretty handily at this time in 2025. It's been kind of interesting how we've had somewhat parallel years where we started the year very sluggish and then saw these massive rebounds. The massive rebound in 2025 lagged the massive rebound in 2026 by a couple of weeks. So that's a strange comparison to make. What's more important is the forward ratio of 21.79. What that tells us is that stocks are actually cheaper than they were a year ago because that number was higher than 21.79 a year ago. And so what's really happened is even with this huge rally, stocks have not grown as fast as their projections for future earnings. And that's really what we base everything on, right? We don't buy a stock for what it's going to make today. We buy it based on what we think it'll profit at a year or 2 years or 3 years in the future. And so to see that number lower indicates that stocks have some room to run, even though on a current basis, they've returned to being a little elevated. We just finished the 2025 fourth quarter earnings season in the first quarter of 2026. So a quarter in the rear. We have companies announce how good they did for the last quarter. In most cases, update projections for how good they think they'll do over the next quarter or the next year. We had an above average series of announcements in the fourth quarter, and the fact that it wasn't amazing, but it was above average, and the stocks declined really started to make this separation where if stocks are going down at the same time profits are going up, then eventually stocks are going to rebound and kind of catch back up. And that's a part of what we saw during this huge April rally, combined with the fact that the announcements so far, we started a new earnings season, I think around April 13th. With some bank stocks announcing. And so the middle of April, we saw a new earnings season. The numbers have been extremely strong so far in this earnings season. And so next month, I'll cover some of those numbers a little more deliberately as we kind of move through that. So it makes sense for stocks to be rebounding is the narrative. A couple high-level economic notes, just in terms of, and I'm going to go through some of these awfully fast in the interest of time, but in the interest of where we think the economy is right now, I'm going to look at a couple of key data points, and I'm going to look at a couple of grades for how we would kind of assess things right now. Total bank credit, this is the annualized rate compared to the year before of how much banks are lending out. So think of the idea this way. Banks will get, even though we don't really perceive it, banks get defensive with their money the same way that you and I would. Meaning that if you think there's a lower likelihood you'll get your money back, you're not going to lend out as much. And banks do the same thing. They go through these phases where they're aggressive lenders, and they go through these phases where they get more defensive because they're worried they won't get their money back. That is one of the biggest indicators of a recession before it happens. That kind of, I use the term grease in the engine, not being out there to kind of lubricate things all of a sudden. We see a very healthy level, actually broke above 6%. I usually tell people we want to see this between 3 and 6%, broke a little bit above that, hovering about a little over 6%. And you can see the gradual climb since mid 2024, where at one point at the beginning of 2024, this number was negative. Now banks are lending at a very healthy rate. Yield curve, I only point out because it's the most uninverted that it has been since 2022. So in 2022, and you can kind of see it in the gray inset chart there, we had the recession that wasn't, where we never technically entered a recession, even with all that inflation, even with the Fed hiking rates. The yield curve was negative for its extended period of time. It's now the most uninverted it has been in a while. U6 unemployment, I usually like to cover because it's more sensitive, and it's basically the core unemployment rate, which is like 4.3%, but this stacks on top of it people that are unemployed or employed part-time for economic reasons. We missed in the gray there in the middle a data point for the government shutdown. And then when we came back online, that went all the way up to 8.7%. So very alarming, especially since that had kind of gradually been climbing over the course of 2025. What's interesting is since then we saw a series of negative results, meaning it returned back to the prior levels, 8.7 all the way down to 7.9, ticking up just slightly in the March numbers. And so that's a big relief, and combine that with initial jobless claims. And so you see a very an incline and then a decline kind of in that graph, where 6 out of the last 7 months have now been declines in terms of initial jobless claims. So this is people filing for unemployment benefits for the first time. We were starting to get kind of alarmed at how that was growing over 2025, but now it's declining so far in 2026. Real wage growth, I always like to point out, because this is part of the formula for the narrative of a stretched consumer. This isn't the whole thing, but it is important, because what this tells us is that in 2023, this was negative because inflation was so high. Since then, for the last 11 quarters, the average wage has grown faster than inflation, which is what we're really looking for to have a strong consumer. You're making money faster than inflation is growing. And so 11 straight quarters of growth there looks very good. Gross output, similar to GDP. I like to cover this in my presentations sometimes because it actually takes a bigger look at the economy than just GDP does. It's also less affected by things like tariffs, by government shutdowns, and so we don't see the volatility that we do in GDP. And what this helps us see is a nice, steady, growing economy in the neighborhood of, the lowest bar there is 3.9, the highest bar there is 4.8, but you see kind of steady growth in the economy, and that that really is what it is when you kind of iron out the static. Manufacturing PMI, so the service sector, a larger services sector has been growing for the last 2+ years. The manufacturing sector has been contracting for most of the last 2 years. All of a sudden, come January, we start seeing these reads above 50. So below 50, contraction, above 50, growth. And for the last 3 months, we've seen these exceptional numbers. I treated it as a one-off, but then we get a confirming number, and the numbers say that our manufacturing sector in the economy is growing again. So services, manufacturing, the vast majority of the economy, both of those are in growth mode right now. The only concern that's really out there is this inflation, and we're looking at the core personal consumption expenditures. which is the one that the Fed looks at to make inflation decisions. So that's why I'm looking at it. Unlike the CPI, which has declined a little bit, this has actually increased year over year from 2.6% up to 3.2%. And so a marginal increase, not a marginal decrease, meaning sticky inflation seems like it's kind of here to stay. That's not necessarily the end of the world as long as the economy is expanding as well, which it certainly is. You've probably heard a lot of talk about whether this is stagflation, and I certainly wouldn't agree with that because the economy is outgrowing the inflation right now. Doesn't mean we wouldn't like to see that number much lower than it is right now. I take the economy and we break it into 4 sections, really 3 sections for the economy, 1 section for market fundamentals, and we're landing on all positive scores right now. Macroeconomics, monetary indicators, strength of consumer. Macro and monetary have been +2 for most of the last, call it 6 months, before we saw some variation. Strength of consumer was a -1 at the end of the year. Mostly because of the improvement in employment figures. We've seen that swing from a -1 to a 0 to now a +1 with the April updates. And so a very exciting turn inside of those numbers. Market fundamentals we still rate as a positive. I'm not trying to break it down into a static score, but we do still think it's a good time to invest given the environment and given everything else that we see. We continue to believe we're in a mid-cycle economic expansion, which is defined by continued growth in GDP, sufficient bank lending, most of the stuff that I just kind of ticked through quickly, you would use to define a mid-cycle economic expansion, aka a bull market. And so we think we're still right square in the middle of one of those, and analysts are always playing the game of trying to find the economic peak. Finally, market positives, neutrals, and points of concern. We're just building a T-graph to kind of finish the thing off and saying how many of these data points, because we follow dozens and dozens of things, how many are positive, how many will we call neutral, how many are negative. The biggest negative is the inflation rate, and that's going to probably be in the negative column for a while as far as I can tell. But we're in an environment where almost everything else is positive, or worst case scenario, you can call some of them kind of neutral. And so you can see kind of how lopsided this thing is becoming, where we've actually been shifting more and more stuff into the positive column. And so it's hard to really be concerned about the economy right now, given this outlay. And so we think it's a good time to invest. We have actually been getting more aggressive with our portfolio starting in early April. And so the market looks strong, the economy looks strong. I appreciate everybody for sticking with us. I tried to explain as much stuff as I could in a short period of time. If you have any questions, feel free to reach out to us, subscribe to our YouTube channel. And like I said at the beginning of the video, you can go to lifetimeretirementpartners.com, find a text version. It's only 3 pages long that summarizes this presentation. You can also find the slide deck that I just went through. That'll be posted there as well, along with a lot of other interesting stuff. I'd also be glad if you submit any questions to the website. I'd also be glad to cover those on some of our upcoming presentation pieces. Thank you so much, everybody. Have a great day.